Hey, what's up everybody? Welcome to Roaring Kitty.
If Storm Queen can do it, so can I. I've imagined turning a few $100 into thousands, maybe even go to the moon. All you have to do is hodl. GameStop, AMC, that thrill, that undeniable pull, that feeling that you have to be a part of it right now. Ever wonder why these meme stocks feel less like sober investing and more like a heart-pounding, high-stakes gamble? Because it is, and you're definitely not alone. Today, I want to dissect the psychology that makes meme stocks investing so addictive and often so incredibly risky. What's going on in our brains that makes them light up? And how do these powerful psychological forces make us want to gamble on the next big thing? Why are meme stocks so captivating? It's a potent cocktail that our brains are quite literally wired to love. Behavioral finance research gives us some fascinating clues. First up, the dopamine hit and the gambling instinct. That rush you feel while watching stock price go parabolic, that's your brain getting a hit of dopamine. That same pleasure chemical released when you win a game or yes, when you gamble. Some research actually suggests that meme stock traders often exhibit risk-taking characteristics very similar to gambling, treating the market less like a place of careful analysis and more like a lottery. It's less about a company's fundamentals and more about that electrifying thrill of a quick win. And then there's gamification, the language used, diamond hands, Tendies, the online battles, the instant feedback loop from trading apps. It feels like a game. This can create what psychologists call an illusion of control, making us feel more in command than we actually are, especially when facing massive uncertainty. And critically, there's the power of the herd. Humans are deeply social creatures. When we see a crowd doing something, our instinct is often to follow. Studies consistently show herding is a prevalent investor bias. If thousands on Reddit are hyping a stock, it can feel like the smart move, even if your own research says otherwise. This is further amplified by three things. First, social media. Platforms like Reddit's Wall Street Bets can become echo chambers where specific beliefs are amplified and reinforced, sometimes leading to what investors call irrational market behavior. Research again confirms that social media discussions and the sentiment within these online communities significantly impact investment decisions, especially for young investors. Second, coordinated action, or at least the appearance of it. The internet and commission-free trading have enabled what academics call coordinated retail risk, where the collective actions of many small investors can genuinely move markets. Being part of that perceived power is a strong psychological draw. Finally, don't underestimate the underdog narrative, the David versus Goliath story. Every retail investor taking on a giant Wall Street hedge fund. It's a compelling narrative that taps into the deep-seated desire to stick it to the establishment. While these pulls are strong, our brains come with built-in glitches, cognitive biases that meme stocks can employ masterfully. The legendary investor Charlie Munger constantly warned about these mental traps.
A case of what I always call man with a hammer syndrome. To the man with a hammer, every problem tends to look pretty much like a nail.
Modern behavioral finance research consistently highlights them too. Let's break down a few big ones. First, FOMO. This is a monster. Everyone's getting rich. I can't miss this. Research shows that FOMO significantly affects investors, leading to emotional, irrational decisions that prioritize short-term excitement over long-term stability. Social media supercharges this, often leading to herd behavior and speculative bubbles. Overconfidence, especially after an early win. It's easy to feel like you've got that Midas touch. Studies show overconfidence is a common investor bias, sometimes more prevalent in certain demographics, and it can lead to excessive risk-taking. Herding, again, it's so powerful, it's worth re-emphasizing. The fear of being the only one not participating can be overwhelming. Then comes anchoring. That first crazy price you saw GameStop hit or a price target screamed on the forum, that number can anchor your expectations, making it hard to adjust, even if it is totally unrealistic. Research identifies anchoring as a key bias affecting investors. Representativeness. If a couple of meme stocks go to the moon, we might unconsciously assume that all heavily shorted, internet-hyped stocks will follow the same explosive pattern. This is the representativeness heuristic that is at play, judging situations based on how similar they seem to past events, even if critical differences exist. Then there's loss aversion. We humans feel the pain of a loss about twice as intensely as the pleasure of an equivalent gain. This makes it incredibly difficult to cut your losses on a falling meme stock. You hold on with diamond hands, hoping it will bounce back, even when logic screams, sell. Then there's confirmation bias. Once you're invested, emotionally and financially, you'll subconsciously seek out information that confirms your brilliant decision. AMC is definitely going to 1,000 because this one YouTuber said so. And ignore all the red flags, it's like wearing blinkers. Availability bias. Those dramatic stories of someone turning $500 into $50,000 or Roaring Kitty's legendary posts, they're so vivid, they're so memorable, and they stick in our minds. This is the availability heuristic, making us overestimate the probability of similar incredible success because these extreme examples are so readily available in our memory.
Well, we're coming back with breaking news because the live stream has finally started. You can see that right there. About 28 or so minutes late, but nonetheless, it is underway. And we'll see exactly what's gonna happen there. Andrew.
The psychological journey of a meme stock investor is nowhere near a gentle ride. Quite the contrary. It's an extreme emotional roller coaster. The initial euphoria of joining a movement, the thrill of seeing those paper gains multiply, it can incredibly validate and be addictive. But the extreme volatility that defines meme stocks means this high can flip into intense anxiety, panic, and deep regret in a heartbeat. The constant need to check prices, the fear of a sudden crash wiping out your entire gains or deepening your losses, this takes a significant psychological toll. It's a level of stress that traditional long-term investing rarely inflicts with such intensity. And for many, the crash, when it comes, leads to more than just financial loss. It can bring feelings of foolishness, frustration, and sometimes a lasting aversion to investing altogether. So how do we protect ourselves from these powerful psychological forces? How do we avoid getting played by our own brains? It's about building what Charlie Munger called psychological resilience and applying some research-backed strategies.
What would you push in that direction if you've got a class full of finance students in college? Maybe what are a few lessons
I would teach to the people who can learn, and if the others couldn't keep up, the hell with them. Well, it can't be improved. I don't believe in butting my head against the wall.
First, awareness is key. Just knowing that these biases exist, FOMO, overconfidence, herding, is the first step to spotting them in your own thinking. Second, have a plan and define your why. Before you even think about clicking buy on that hot meme stock, ask yourself, how does this fit into my actual long-term financial goals? Is this play money I can truly afford to lose? Or am I risking capital I need for the future or for my life or my family? Don't let a wave of emotion derail a sound pre-existing strategy. Third, challenge the herd and actively seek discomforting evidence. Don't just consume hype. Actively look for reasons not to invest. What are the counter arguments? What are the holes in the to the moon narrative? This is what Munger called inversion, thinking about what not to do. Fourth, respect your circle of competence. Another Munger gem. Do you actually understand the company, its business model, its real valuation, or are you just betting on the meme and on the crowd? If you cannot explain it simply, you're outside your circle, and that is gambling and not investing. Fifth, separate gamble money from serious money. If you absolutely must participate in the meme stock casino because it's so cool, use only a very small amount of money that you are genuinely prepared to lose entirely. Don't let it bleed into your serious long-term investment capital. And finally, cultivate a long-term thinking mindset. I know it's hard, but true wealth is rarely built overnight. It's usually the result of patience, discipline, and consistent, often less thrilling habits. The meme stock frenzy is the antithesis of that. Look, I will admit, meme stock mania is a fascinating, powerful psychological phenomenon. It's fueled by genuine social dynamics, amplified by technology, and deep-rooted in our own cognitive biases. It vividly demonstrates how human emotion, not just cold, hard logic, can drive markets. But by understanding the psychology that makes you want to gamble on the next GameStop, by recognizing these mental traps, you can make more conscious, rational decisions. True financial empowerment doesn't come from chasing the next viral sensation. It comes from investing with clarity, a plan, and a mastery of your own mind. What psychological factors do you notice in your own investing journey? Whether it is with meme stocks or with something else, what strategies help you stay rational and avoid these emotional decisions? Share your insights and experiences. If this psychological deep dive into the world of meme stocks was interesting to you, please hit that like button. And if you haven't already, consider subscribing for more content that blends finance with human behavior, helping you master your money and your mindset. Thank you so much for watching. Stay informed, stay rational, and I'll see you on the next one on the way to the moon. Have a great one.